I made a video about CPI last month on February 10th when the CPI data came out. At that time, Wall Street was predicting that CPI would peak in February and that we are going to see a downturn to about 2.5 to 3% CPI year over year by second half of the year. Boy, we got that wrong. No one was expecting Russia-Ukraine situation. No one was expecting energy crisis. No one was expecting commodities prices to soar, and no one was expecting wheat to touch all-time high. Guess what? It's all happening now, and Fed is no longer the hot topic. It's Russia and Ukraine situation. And I just heard on the news that as nickel prices soar, that is going to keep semiconductor supply chain issues to drag longer than we initially expected. You see how it's all like interconnected? And in all this, we are going to get the latest CPI read data today at 8:30 a.m. There are few things to note and also what to expect from the market. Let me share the screen and let's take a look at few key points. And if you're watching this video before the CPI release, then pay attention to the year-over-year inflation number because that's going to dictate how market is going to react today. And when the actual numbers comes out, and if you are watching this after the release of the numbers, then pay attention to the housing component because that makes about 1/3 of the index, and also services sector because that may tell us what to expect from the labor market in the coming weeks and months. So let me share the screen quickly and let's go over a few things. So first, I would like to share this screenshot that I shared in my February 10th video. This was from February 2022. And if you pay attention over here, analysts were expecting that we are going to see or we are going to get the peak inflation about March. This is what they were expecting, that we are going to get in February and March, we are going to peak in inflation, and the peak inflation at that time was about 7%. That's what they were saying. Take a look at this now, how the graph has changed. This is where we are right now. They are expecting the inflation to touch almost over 8% to almost 9% going into next few months. So inflation not only going to last a lot longer than previously anticipated, but at the same time, inflation is now going to go to other sectors. So pay attention to these sectors over here. White is the new and used vehicles. Orange is energy, blue is other CPI component, and then pink is the overall CPI data. So if you pay attention, vehicle or used car prices were supposed to come down to almost, I would say, 2.5 to 3%. But pay attention to this. Now the used car prices are going to stay at about 6%. Before, all other CPI components were down to about 2%, and now all the CPI component is going to be above 4%. That's double than what they were expecting before. On top of that, pay attention, energy. Energy was one of the things, if you pay attention till last month, just a month makes such a huge difference. In January, or when the CPI data came out in the February, they were talking about energy almost non-existence in the second half of 2022. Now pay attention to this. Energy not only is going to remain a big focus, but also the energy inflation going to remain at about 6%. This is massive because energy, of course, is a huge sector of where the inflation is or how the inflation is calculated. But at the same time, all these data, this predicts one thing, that we are going to see pain in the markets, that analysts are expecting a gain of about 0.9% in the headline and 0.5% for the core inflation. Now 0.9% headline inflation, that's massive, and we are going to see some really high numbers come out of the CPI data. Now CPI data, as it came on February 10th when it was released, we had a shock because nobody was expecting that high of a CPI data to come out. And when it came out, market reacted. But market reacted only for a day. This time, if the CPI data comes out really bad, I expect the same thing, that market is going to react badly for a day and then it's going to recover a little bit because you know what I'm seeing more and more? I'm seeing that the fear in people's mind, because we are so used to of these reds, of these losses, is kind of diminishing. People are seeing, yes, market is bad. Yes, it has been bad. Yes, we have lost 50%, 60% on our portfolio, but how bad can it get from there? So in my opinion, this is how it's going to work. First of all, people, those who have almost lost 80% or 70% on their stock portfolio, are not going to sell their portfolios because it went down another 5%. I think they're going to hold on to their portfolios or their positions because they feel that another 5% is not going to hurt them because they're already down 75, 80%. Ask me, I have some positions, those who are down 75, 80%. Am I getting out of them? No, because I felt like if I've passed through so much pain already, What's other 5% is going to do to my portfolio? Not much. If the reading comes out, let's say 1% or 1.2%, then we are going to see a shockwave in the market, but that's going to be a temporary shockwave. I think the bigger worry that we have at our hands right now is Russia and Ukraine situation. And if we see a sell-off because of CPI, that's going to be very temporary. And I'm going to take advantage of that. I'm going to explain to you in just one second how I'm doing it. Now, inflation is also now broadening into other categories, especially after Russia and Ukraine situation, transportation, insurance, and few others. And we'll see the inflation continue to have higher or greater impacts in these sectors for the coming months. Because this is new. This is new for the inflation. This is new for the whole CPI data that comes out, because inflation was not seen in these sectors, but now it's been seen in these sectors because of the latest situation that we have. And of course, this was not priced in before. And that is why we see this prolonged effect on inflation. Look, energy was almost gone by the second half of 2022. Not anymore. Energy is going to be a main factor. The core CPI inflation, look, the blue lines here, is actually going to be a big deal going forward into the second half of 2022. So now looking ahead, what comes after this? I'll share a chart that simply shows what US inflation is going to be if the oil prices continue to surge. So take a look at this chart right here, and I'm going to briefly go over. This is March CPI inflation under oil scenarios. So over here was $92 a barrel. That was pre-Ukraine and Russia war. Then now about $120 a barrel, or somewhere around that range. We are expecting about, I would say, 9% inflation. If the oil goes to 140, we are touching almost close to 10. 160, 180, and 200. The worst case is if we hit $200 a barrel, or if we hit $180 a barrel, we are going to see inflation reading above 10%. That is not going to be a good news for the markets, because inflation not only does slow down the economy because people are not spending money, they're scared, but it kind of plays around with the people's mind when they see that they're paying almost $5 a gallon for the regular gas at the pumps, where they spend their money. The restaurants, the other luxury items that we usually go and tend to spend money because we have that cash, are now out of the window. That's going to hurt small businesses. That's going to hurt the services sector. That's going to hurt the industries that are already struggling because of pandemic. So these are this chart was so interesting to watch, that, as oil goes $20 per barrel, look at the inflation reading, almost a % jump. This is bad news, because if you look over here at $120 a barrel, we are already touching 9. And then by the time we get to about 200, we are going to be over 10.5, or around close to 10.5 to 11%. So now here's the bad news. Based on what I am seeing in the reports, that inflation reading will be bad for months to come. The bet was that inflation will subside by the end of the year. Will not happen that soon, and it's not going to happen. As per this report, inflation will hold about 8% for the year, and then will drop about 7% by the fourth quarter, only if crude oil prices remain where they are between $100 and $120 a barrel. Now, there is a major push in scaling the US oil operations, so we can see some easing on the pain, but that's only going to come with time. Everything, something like this, like scaling the oil production, takes time, and it's going to happen towards the end of the year. So given all that, when do you decide about your stocks, and what do you do? So here is the plan I'm doing, or I'm following, given the current market condition. I plan on selling covered calls and getting out of my 2023 options for loss at this point. I will wait till we get the war under control. I'm not liquidating any positions right now, but I feel, knowing from both sides, that we cannot, or the war cannot keep on going forever, and war will end. And we will see a flash rally which could actually last a week or more. But then focus will be back on Feds and inflation. And to cover inflation, Fed will have to be more hawkish, which market will react negatively. I will also look into shorting few volatile stock by options, not naked shorts. I don't like that feeling. If you haven't watched my first ever experience with shorts, I will link that video towards the end of this video, so definitely watch it out. And if you enjoyed the video, then give it a thumbs up and consider subscribing. And for more one-on-one conversation, consider joining our Discord and Patreon. Links are in the description. As always, a pleasure to share all of this. Let's hope that we get some good news today, also in the coming weeks. Until next time, you all have a sparkling day.